All right, let's dive right in. Today, we're going to break down a specific trade idea on the software giant ServiceNow, and we're going to look at it from three completely different angles. First, the math behind the potential return. Second, the story the stock chart is telling us. And third, what the company's actually worth.
So why are we even talking about this trade? Well, it all starts with this number. We're looking at a potential annualized yield of almost 25%. Now, getting that kind of return on a blue-chip company is pretty incredible. So the question is, how on earth could you generate that?
Okay, so the strategy we're exploring is selling a cash-secured put. Now, in plain English, that just means you're getting paid a premium today for simply agreeing to buy ServiceNow shares later at a price that's lower than it is right now. We're looking at the $75 strike price that expires on June 18th. So if the stock drops to $75, you buy the shares. If it stays above that, you just keep the cash you were paid up front. Simple as that.
First up, let's tackle angle number one, the math. That potential return is obviously the hook, but it is absolutely crucial to understand exactly where that number comes from and, what the real risk is.
So here's how we get to that big number. First, you look at the absolute return on the cash you have to set aside. The trade requires you to have $7,500 on hand, and for that, you collect about $350 in premium. That's a straight-up 4.67% return. But, and this is the key, the trade only lasts for 69 days. So to really compare it apples to apples with other investments, we annualize it. And that simple math is what gets us to that potential return of nearly 25% a year.
And this gives us some other really important metrics. So your break-even price isn't actually $75. Once you subtract the cash you collected, your real break-even is down at $71.50. And that means you have this huge downside buffer of over 19%. Think about that. The stock could fall almost 20% from where it is right now before you would even start to lose a single penny.
Okay, so the math looks pretty compelling, but this brings up a huge question. Why $75? Why that specific number? Well, it's not random, and this is where our second angle comes in, reading the technicals to see where the stock might finally find a floor.
Let's be honest, right now, ServiceNow's chart looks an awful lot like a falling knife. It's just sliced through all of its key moving averages. But technical analysis does point to a few key areas where a bounce might happen. It's kind of fighting at its 52-week low as we speak. Below that, you've got this zone where algorithms might jump in for a quick bounce. But the level we're really interested in is this third one, which you could call the extreme flush level.
And this is the whole theory behind picking the $75 level. Technical models suggest that for this stock to get maximally oversold, where everyone just gives up and sells, it needs to fall to around $75.50. A drop that bad, that fast, often triggers automated buying programs, which can cause this incredibly sharp, violent reversal. So picking 75 isn't a guess. It's designed to align with a point of maximum panic and maybe maximum opportunity.
So we have the math and we have the chart. But what if we're totally wrong? What if the stock just blows right past $75 and we're forced to buy the shares? Well, this brings us to our third and honestly probably the most important angle. What is the fundamental value of the company we'd be buying at that price?
To figure this out, we're going to use something called the PEG ratio, which basically tells you if a stock is cheap or expensive compared to its growth. And we're not even going to be optimistic here. We are using a pessimistic growth forecast of 16%, which is based on a recent downgrade from a UBS analyst. So, real quick, here's the thought process. First, we find the implied earnings per share. Then, we calculate what the new PE ratio would be if we bought the stock at 75. Finally, we just divide that by the growth rate to get our PEG ratio. And after running all those numbers, we land right here, at a PEG ratio of 1.17. Okay, so what does that actually mean?
This is why that number is so powerful. In the framework made famous by the legendary investor Peter Lynch, a PEG ratio of 1 is considered fair value. So at 1.17, if we had to buy the shares, we'd be getting a high-quality, blue-chip software company at a price that is right on the edge of being fundamentally fair.
Okay, so we've analyzed the math for our return, the technicals for our entry point, and the fundamentals for our worst-case scenario. Let's pull all three of these threads together and see what we've got. So when you step back and look at everything, what's the complete story that this three-angle analysis is telling us?
Well, the full picture is actually a very cohesive one. The math gives us a really attractive yield with a huge margin of safety.
The chart suggests our strike price is strategically placed right at a level of potential panic and reversal. And most importantly, the fundamental valuation tells us that even if we're wrong and get assigned the stock, we'd be buying it at a very reasonable price. You see how each angle really supports the others?
Of course, I absolutely have to remind you, this is all just a breakdown of a trading idea for educational purposes. This is not financial advice. Every investment involves risk, so please always do your own research before making any decisions.
And that really leaves us with the central question every single trader has to ask themselves in a spot like this. By combining these three angles of analysis, the math, the chart, and the value, does this trade represent a calculated, risk-defined entry point into a great company, or is it just an attempt to catch a falling knife? That's the core tension, and definitely something to think about.